Good morning, everyone. Good morning, ladies and gentlemen. Welcome to the show. You know, what tops in the news right now is the China-U.S. trade tariffs, and they've just come into effect. This is a trade war. It's heating up. China has said that they're going to come back and they're going to retaliate. Well, we're going to have to see what's going to happen. But we're going to move right into the top stories that are happening today in these markets. And so what we're going to do is we're going to open up the charts right here. And now what we're going to look at first is Deutsche Bank. You know what? Deutsche Bank has been tumbling lately. And we all knew this was eventually going to happen. But, you know, I'm going to tell you guys what. There's some sort of a buyer in here. Now, when Deutsche Bank yesterday, it went down as low as 6.95 euro. Somebody come in and caught the falling knife and took it all the way up to 707 euros. But you know what? It started to drop again on them. And then they caught it again this morning at 6.81 euros. And they drove it all the way up to 7 euros again. And now it's falling again. And so what they're basically doing is, I guess they think that it's a good value on these stocks because they're cheap. I don't know exactly what they're thinking is, but they're getting burnt each time, you know. It's going to continue to fall. Deutsche Bank is on its way. I think I know what they're thinking is. What they're thinking is Deutsche Bank's down as low as it's going to go, and the government's going to bail them out or something's going to happen because they're too big to fail. And this just can't happen. I think that's the way they're thinking. But you know what? Yes, it can happen. Deutsche Bank is going down. I've predicted in the past that Deutsche Bank, once it goes below 6 euro, then it's going to fall fast. It's going to be a Lehman moment. And I don't see anything coming to stop this from happening. It's just on its way down. If we take a look at the 1-year chart, we can kind of see this. You can kind of see it better that Deutsche Bank is going down. If you look at the 1-year chart here, it's just a steady slope toward the abyss. And what's going to come in to really stop this from happening? Anyway, let's take a look at something else here. The Fed. Guess what? They're not going to do quantitative easing. Quantitative easing was too restrictive. Basically, they're saying like, okay, we're going to make $40 billion a month worth of buying these junk, this garbage from the banks. I forget what they called it. They call it mortgage-backed securities or whatever. And then we're going to do $40 billion more a month to make it $80 billion total in quantitative easing. We're going to do $40 billion more a month I think they call it mortgage-backed securities or whatever. And then they did 40 and 40 anyway. They did $80 billion a month when we had quantitative easing. That was too restrictive. It was setting a dollar point on it to where they were restricted to a certain point to their balance sheet. But guess what they're planning on doing this time? Instead of calling it quantitative easing, they're going to call it a rate peg. They're going to call it a peg to the. They're going to peg the. This program is yield curve targeting. This is what they're going to be doing. But it's not going to be near as restrictive as quantitative easing was. This is basically a hard target, and it doesn't matter what the cost is, whether it's $80 billion a month or $500 billion a month. It doesn't matter. You know, it's a hard peg. The Bank of Japan's already been doing it. They control their yield curve all the way out to the 10-year yield, the Bank of Japan. It says a program by which it tries to control the entire yield curve, including the 10-year. Now, this is a rate peg, and this is what they're planning on doing at the Fed during this next round of quantitative easing. I'll call it quantitative easing, but it's worse. It's like unlimited quantitative easing. See, they had a hard limit before of $80 billion a month. Now there's no limit in there. It's just a hard, solid rate peg. And with this rate peg, I mean, it could be it doesn't have to stop at 80 billion a month. It could be like 200 billion a month, 500 billion a month. It doesn't matter, whatever it costs. It's just an interest rate peg. People don't talk about it so much, but it's basically, it says the Fed would announce that it wants a 1-year yield to be at 1%. And the Fed is credible for this announcement. Yes, they are, because they're just going to do it whatever it costs. Doesn't matter. They're going to peg it to 1%. And this is the idea. It says they're floating a trial balloon on this. It says the Fed has already done this before, back in World War II, to provide cheap financing for the U.S. war effort during World War II. It says the interest rate peg became effective in July 1942 and lasted through June 1947. The Reserve Bank reduced their discount rate to 1% and created a preferential rate of 0.5% for loans secured under short-term government obligations, substantially below 3 to 7% that had been common during the 1920s. Okay, so they've done this before. They're going to control the yield curve. This is where they're headed next. I think this is it. This is their new quantitative easing. It's a rate peg instead of quantitative easing. That way they don't have a set amount of money behind this. They can just do however much money it takes. It doesn't matter. This is basically a whatever it takes sort of a deal. This is going to have a profound effect upon the markets, you know. So now let's move on to the gold price today. And where we see gold going today is up $2.30 so far on the day. $12.8570 for gold. Let's check out silver. Silver's even with the board right now. It was up earlier. It's at $14.72 today so far. And we're going to shift over to Bitcoin now. And you know what we noticed with Bitcoin? 63.22. Let me refresh the page. 63.43. It's just continuously marching upwards. It's 4.85% up on the day so far, just on today alone. That's almost 5%. 63.43. Starting to look more and more like the Bitcoin bear market is over, and we're charging into a new bull market. Probably on its way to $100,000 a coin, you know, and then it'll probably pop and be devastating when it pops. But the thing is Bitcoin does this. It goes into these bubbles and then it pops, you know. And now let's take a look at, I call it the bubble machine, Bitcoin. It's going into another bubble. I think it's starting to head into another bubble. Market cap, 192.1 billion. Bitcoin dominance of 58.1%. How massive will this bubble be? I think this is going to be a pretty big one. I think it's going to be the biggest one ever. It always pops, but you know, I think this is going to be the last bubble pop. The last time Bitcoin goes into a massive bubble and then pops. I think the following one after this one, it might, gosh knows how long it might be. It might be 2 years from now or 3 years from now. The following one, when it goes into this final, like a bubble, goes up and up and up, I don't think it's going to pop on the final one. I think it's going to go up and up and up and stay up on the final one. But that's not this one. This one's going into a bubble again that's going to pop. But anyway, let's move on and, well, let's take a look at these coin prices real quick. What we're looking at is Bitcoin here. It says 63.05, Ethereum 172 bucks, XRP is 29 cents. I've been saying for days, weeks, months, maybe even years about how I don't like the fact that XRP's got 50 billion coins sitting in the wings. They've got 42 billion coins on the market right now, but they got 50 billion more sitting in the wings. I don't like that. Bitcoin Cash, 285 bucks. Litecoin, $76.46. EOS is at $4.83, and Binance Coins at $19.31. Stellar's at 9.2 cents. Cardano's at 6.3 cents. And Tron is 2.3 cents. Monero 66.15. Bitcoin SV is 58.02, and Dash is $114. Now let's move on to the Dow Jones today and take a look at what it's doing. I'm going to have to refresh the page. She's down 113 points on the day. Well, now it's down 108. The Dow Jones, like I say, it's been Teflon. This news is huge. And it hasn't taken the Dow Jones down that much yet. We're going to have to wait and see what it does. But you know when the Dow is really going to move down is when the Dow really wants to move down on its own. Not so much these news. The Dow has been Teflon, but this cooling off in the Dow, you know, we're going to have to wait and see what happens with the Dow. But the Dow has moved up on all these corporate earnings and everything else, and these corporate share buybacks and everything else, and it's been overinflated for a long time. It's had 3 tops. If the Dow moves down significantly, they got your back. They will go into these new programs that they're talking about, the Fed's talking about, and they will control the yield curve, and they will stimulate this Dow Jones market if they have to, and they will prop it back up. They got its back. But when they do that, they're going to start to create inflation. That's the moment they're going to start to really create serious inflation. Okay, over at John Williams at Shadow Stats, he says that the inflation rate in the United States right now is 9%. He's probably right. They say that the inflation rate, they want to target a higher inflation rate, the Fed. And so they're looking for more inflation than 9%. They want 20%. They want 30% inflation. And by gosh, they'll keep working until they get it. Let's take a look now at oil. Oil's $61.80. It's up 10 cents on the day. The oil price is holding pretty steady now. Let's take a look at U.S. Treasuries. Now, if they do these yield curve pegs, I'm just going to drop doing Treasuries off of my list, you know, because they'll be controlling this whole yield curve completely all the way out to the 10-year. It'll be just set, and every day it'll be the same thing, so I'll have to drop doing Treasuries. But until they do that, the Treasuries are on the move right now, and they're moving seriously, you know. We've seen serious moves downwards in the Treasury yields as of late. Now let's take a look. Well, this is moving us more toward this yield curve inversion. It's moving us deeper into this yield curve inversion. Now let's take a look at the U.S. dollar index today, and we see it falling off a little bit. It's 97.23. It's almost getting ready to drop down into the 96s for the U.S. dollar index. You know, in the long term. Now in the short term, it looks good for the dollar, but in the long term, it's really bad. But let me explain something. This U.S. dollar index is weighing the dollar against a basket of other currencies, of which the euro makes up like 60% of this basket. And so basically you're comparing, it's a comparison of the dollar against these other currencies, and the dollar looks strong against these other currencies, but these other currencies are garbage that it's being compared against. So now, if you were to, instead of comparing the dollar in the U.S. dollar index against these other basket of currencies, if you were to compare it against Bitcoin or against gold, the dollar would diminish greatly and much faster. You know, it's all in what it's being compared against. You know, that's basically how it works. Listen, thank you guys for listening to this market report. I really appreciate my audience out there. And you guys have a great day, and give me a thumbs up. Bye-bye, guys.